Hi, I'm Sofang. I'm the Portfolio Manager for United Asia Pacific Real Estate Income Fund. A real estate investment trust, or a REIT, is a highly regulated investment asset class which invests in a portfolio of real estate assets, for example, your retail malls, offices, hotels, and industrial properties. Listed REITs are part of equities and trade on the stock exchange. Importantly, REITs are required to distribute a minimum of 90% of its taxable income as dividends to its shareholders, and these dividends are backed by regular streams of rental income paid by the tenants to property owners. REITs have a relatively low correlation with major asset classes, especially the broader equities market, including the listed real estate sector. As such, they make a good investment tool to diversify one's overall portfolio risk. One of the key characteristics of REITs is its defensive attributes. REITs are equities but with bond-like features. They pass on 90% of its profits in a form of dividends, providing investors with regular and stable income growth. At the same time, REITs offer investors potential capital appreciation, typically through revaluations and enhancements of its underlying real estate properties. We view the current market environment as conducive for REITs. Property-level fundamentals remain supportive despite macro-level headwinds from central bank interest rate rises and rising bond yields. More recently, even as we expect heightened geopolitical risks and concerns over stagflation to temper growth expectations, the APAC region remains in various phases of economic reopening and is poised to benefit from post-COVID economic growth. Valuations are relatively attractive, and conditions supporting a healthy REITs sector earnings growth are largely intact. Overall, tenant demand continues to see improvement across most sectors, and we expect leasing momentum to pick up moving forward. An inflationary environment which is associated with economic growth is generally favorable to the REITs sector from the perspective of rental income growth and appreciation in asset capital values. REITs may enjoy optimal benefits of an inflationary backdrop provided if there is only a small and gradual rise in interest rates. As such, act as a good hedge against inflation. REITs are priced for its defensive yields. While it may be intuitive to dismiss REITs in the face of rising interest rates, we note that the sector often trades well in rising interest rate cycles if it is accompanied by positive dividend growth. We aim to invest in REITs with strong earnings growth, which should translate to higher dividends. Such REITs may outperform in current market environment, given the relative ability to offset compression in yield spread premium. We expect dividends of Asia Pacific REITs to grow by an average of 5.2% per annum over the next 2 years, translating to attractive dividend yields of 4.2%. Growth is well underpinned by a cyclical uplift in rents from normalization in economic activities and abatement of rental waivers. Real estate property acquisitions by REITs over the last 12 months should also boost growth. To give you some color, Singapore REITs offer one of the most attractive dividend growth profile within the APAC region. Appetite for overseas asset acquisitions remains strong, especially within the industrial and office REITs, and we believe this should continue to support valuation re-rating. In Australia, logistics remain resilient with solid rental outlook in key cities due to tight supply. Over in Japan, we have a preference for Japan REITs with strong active asset recycling potential to complement organic growth. Despite the fact that new supply of office space in metropolitan Tokyo is expected to come on stream over the next 2 years, we see pockets of opportunities emerging, especially in smaller size office properties. We have a cautious view on Hong Kong REITs. Despite this, we see good value in retail REITs with exposure to non-discretionary sectors, namely your suburban malls, for its relative earnings resilience. The United Asia Pacific Real Estate Income Fund invests in different types of REITs across the Asia Pacific region and aims to provide investors total returns through dividend income and capital appreciation over time. The fund is one of the most pure REIT-only fund compared to other specialty real estate fund peers, with the latter typically comprising investments in a range of real estate-based companies beyond REITs, such as your property development companies and property management services. UOB Asset Management is leveraging our Asian heritage and local investment expertise through our extensive presence in Asia. The fund is a UOBAM certified ESG enhanced fund, which means that we integrate ESG into the investment methodology, and this includes investing in companies with better ESG scoring. Some of the key concerns worth keeping a close watch on are a drastic slowdown in global growth due to the prolonged uncertainties from the Russia-Ukraine geopolitics. Also, a surge in interest rates could translate to higher borrowing costs as well as lower property valuations. While a moderate level of inflation is generally beneficial to the REIT sector, these benefits from rental income growth and asset capital values will diminish as inflation overshoots or if interest rates rises beyond a certain threshold. Thus far, the impact from interest rate hike appears manageable. The overall gearing of APAC REITs is far below the maximum allowable limit, and REITs with under-leveraged balance sheet can better deliver inorganic growth and outperform. It is also worth to note that most REITs have hedged a good portion of their total debts on fixed rates. For instance, Singapore REITs have on average hedged 70% of their debts to minimize interest cost expenses amid rising interest rates.